DCA, dollar cost averaging, a simple yet effective strategy.
Hey everyone, and a super warm welcome back to the X100% channel. I'm your host, Eddie, and today we're tackling a topic that's incredibly relevant, especially in today's dynamic market environment. You know, the kind of market where one day everything's soaring, and the next day it feels like the floor just dropped out from under you. I remember when I first started thinking about investing, it was all so intimidating. Everywhere I looked, there were charts going up and down, financial news screaming about bull markets and bear markets, and everyone seemed to have a guaranteed tip for the next big thing. Honestly, it felt like I needed a crystal ball just to decide where to put my money. And the biggest fear? Buying at the top right before everything crashed. That kept me up at night. Does that sound familiar to anyone? Well, if you've ever felt that way, you're in exactly the right place. Because today, we're going to demystify a strategy that can help soothe those investment anxieties, smooth out those market roller coaster rides, and build your portfolio in a way that's both smart and surprisingly simple. We're diving deep into the world of dollar cost averaging, or DCA, a strategy that's been a cornerstone for savvy investors for decades. Now, you might be thinking, dollar cost averaging? Sounds complicated. Trust me, it's not. In fact, it's the beauty of its simplicity that makes it so powerful. Think of it like this. Imagine you're planning to build a beautiful brick wall. You could try to buy all the bricks you need at once, hoping you get the best price and timing it perfectly. But what if the price of bricks suddenly skyrockets after you buy them all? Or what if you buy them all at once and then realize you bought way too many, or not enough of the right kind? Dollar cost averaging is like buying bricks for your wall little by little over time. Maybe you buy 100 bricks every month, regardless of whether the brick market is up, down, or sideways. Some months you might pay a bit more per brick, other months you might get a bargain. But over time, you'll accumulate all the bricks you need, and you'll likely have paid a more stable, average price per brick than if you had tried to time the market perfectly and buy them all at once. So, let's break down the mechanics of DCA in more detail. Let's say you've decided you want to invest a total of $24,000 over the next 2 years. Instead of taking that whole $24,000 and throwing it into the market all at once, which again is called lump sum investing with DCA, you strategically spread out your investments. You might decide to invest $1,000 every single month for those 24 months. Rain or shine, market up or market down, you commit to investing that consistent $1,000 each month into your chosen assets. This consistent, methodical approach is the heart of DCA. You're not trying to be a market guru, predicting the peaks and valleys. You're simply being disciplined and regular in your investing habits. It's like setting up a financial autopilot for yourself. Now, why is this approach considered so effective? What are the real advantages of choosing DCA over other investment strategies? Let's delve into the core benefits. First and foremost, DCA is a powerful tool for risk mitigation. This is perhaps the most compelling reason why so many investors, especially those who are newer to the game or more risk-averse, gravitate towards DCA. Let's revisit our $24,000 example. Imagine for a moment that you had invested all $24,000 right at the very peak of the market. Think of it as buying all your bricks just as brick prices hit an all-time high. Then, inevitably, the market corrects, as markets always do, and your investment portfolio suddenly looks less impressive. In fact, it might be showing a significant loss. That can be a really tough pill to swallow, especially when you've just put in a large sum of money. With DCA, because you're spreading out your investments over a long period, you are inherently buying at a variety of price points. Sometimes you'll be buying when prices are relatively high, yes. But crucially, you will also be buying when prices are lower, perhaps even during market dips or corrections. This averaging effect is incredibly powerful. It smooths out your overall purchase price, reducing the impact of those unfortunate times when you might have otherwise bought in at a market peak. It's like driving on that bumpy road, and suddenly, someone paves it over, making the journey much smoother and less jarring. You're not trying to dodge every pothole, you're just consistently moving forward, and the overall ride becomes significantly more comfortable and predictable. This dramatically reduces the risk of significant losses right out of the gate due to poor market timing. Beyond risk reduction, DCA provides invaluable emotional control. Investing is not just a logical, mathematical exercise. It's deeply emotional. We're dealing with our hard-earned money, and seeing its value fluctuate can trigger a whole spectrum of emotions, from euphoria when the market is soaring to outright panic when it's plummeting. These emotional swings often lead to impulsive and often detrimental decisions. People tend to panic sell when markets decline, locking in losses, or become overly exuberant during bull markets and buy high, just before a potential downturn. We've all heard the phrase buy low, sell high, but our emotions often lead us to do the exact opposite. Buy high when we feel FOMO, fear of missing out, and sell low when fear takes over. DCA acts as a powerful emotional buffer in this chaotic landscape. Because you're investing on a predetermined schedule, the need to constantly monitor the market and react to every up and down is significantly reduced. You have a plan and you stick to it. This systematic approach removes the temptation to make those emotionally driven, knee-jerk reactions to market noise. You're not trying to be a financial fortune teller, desperately trying to predict the next market swing. You are simply being consistent, patient, and disciplined. This can be incredibly liberating, especially for those who find the emotional roller coaster of investing overwhelming. It allows you to invest with a cooler head and a longer-term perspective. And lastly, but certainly not least, DCA fosters consistency. Building substantial wealth through investing is a long-term endeavor, a marathon, not a sprint. Consistent contributions made regularly over time are absolutely crucial for long-term success. Think of it as planting seeds in a garden. You don't plant all your seeds on one day and hope for a massive harvest the next week. You plant them consistently throughout the growing season, nurturing them over time. DCA is your financial equivalent of consistent seed planting. It forces you to invest regularly, transforming investing into a reliable habit, not just a sporadic activity. Even seemingly small amounts, when invested consistently and allowed to benefit from the magic of compounding over many years, can grow into surprisingly significant sums. It's like the persistent drip of water that eventually carves deep canyons. Small, consistent actions, repeated diligently over time, create truly massive results. So, now that we understand the why behind DCA, the risk reduction, the emotional control, the consistency, let's move on to the how. How do you practically implement a dollar-cost averaging strategy in your own investment journey? The good news is it's remarkably straightforward. Step 1. Define your total investment goal and time frame. Start by figuring out how much capital you want to invest in total and over what period of time. Do you aim to invest $50,000 over the next 5 years to save for a down payment on a house? Or perhaps $100,000 over 10 years for retirement? Having a clear goal and time frame will help you determine the appropriate investment amount and frequency. Step 2. Choose your investment frequency. Decide how often you want to make your investments. Common frequencies are weekly, bi-weekly, or monthly. For most people, monthly is a very practical and manageable starting point, aligning well with typical pay cycles. The crucial element here is consistency. Stick to your chosen frequency, regardless of market fluctuations. Step 3. Select your investment vehicles. Determine what assets you will be investing in. This could be a wide range of options depending on your risk tolerance and investment objectives. Popular choices include stocks, exchange-traded funds, ETFs, that track broad market indices, mutual funds, bonds, or even cryptocurrencies, if you're comfortable with higher volatility and have done your research. Make sure your chosen investments align with your overall financial plan and risk profile. Step 4. Leverage automation. In today's world of online investing, automation is your absolute best friend when it comes to DCA. Most reputable brokerage platforms and investment apps offer features to set up automatic, recurring investments. This is a game changer. You configure it once, specifying the amount, frequency, and the investment assets, and then you can essentially forget about it. Your investments will be made automatically, according to your chosen schedule, without you having to manually initiate each transaction. Automation removes even more of the emotional and logistical friction from the DCA process, making it incredibly easy to stay disciplined and consistent. Step 5. Commit to your plan and stay the course. This is perhaps the most critical step. There will inevitably be times when you'll be tempted to deviate from your DCA plan. Perhaps the market takes a sharp downturn, and you might feel a strong urge to stop investing, fearing further losses. Or, conversely, if the market is booming, you might get caught up in the hype and feel tempted to invest more than your planned amount, chasing those perceived gains. Resist these urges. The inherent strength of DCA lies in its unwavering consistency. Ride out the market's inevitable ups and downs, and maintain your faith in the long-term strategy you've set in place. Remember, DCA is not about timing the market perfectly. It's about consistent, disciplined participation over the long haul. Now, is dollar-cost averaging the perfect investment strategy for absolutely everyone in every situation? Well, like any financial strategy, DCA has its nuances and potential limitations. One key caveat to be aware of is its performance in a consistently and rapidly rising market, what we call a strong bull market. In such a scenario, lump sum investing, where you invest your entire sum at the very beginning, could potentially yield higher overall returns. This is because you would have bought in earlier and benefited from the entirety of the upward market trend. However, and this is a crucial point, consistently predicting and accurately timing these kinds of sustained bull markets is exceptionally challenging, even for seasoned professional investors. And remember, DCA is fundamentally about mitigating risk and reducing emotional stress, not necessarily about maximizing returns in every conceivable market scenario. It prioritizes a smoother, more predictable investment journey over the potential, but highly uncertain, possibility of achieving slightly higher returns by trying to perfectly time the market with a lump sum. All right, let's pause for a moment and consolidate our understanding of dollar-cost averaging. Let's distill the key takeaways into a concise summary. In essence, dollar-cost averaging is a simple yet powerful investment strategy that involves investing a fixed sum of money at regular intervals over a defined period, rather than investing a lump sum all at once. We've learned that DCA effectively reduces investment risk by averaging out your purchase price. This minimizes the risk of investing a large sum right before a market correction and smooths out the overall volatility of your investment journey. DCA provides invaluable emotional control by removing emotion from investment decisions. It encourages a disciplined, systematic approach, helping you avoid impulsive reactions to market fluctuations and stick to your long-term plan. And DCA powerfully promotes consistency, turning investing into a regular habit. This consistent participation over time allows you to leverage the incredible power of long-term compounding and build wealth steadily and reliably. We also explored the practical steps to implement DCA effectively. Define your investment goal and time frame, choose your investment frequency, select your investment vehicles, automate your investments, and, most importantly, remain committed to your plan, weathering market ups and downs with patience and discipline. Finally, we acknowledged a potential limitation. In a rapidly and consistently rising market, lump sum investing might theoretically outperform DCA. However, DCA's strengths lie in risk management, emotional stability, and consistent wealth building, making it a highly valuable strategy, particularly for those seeking a less stressful and more predictable investment path. So, to circle back to our initial question, is dollar-cost averaging the right strategy for you? If you're seeking a way to ease into the world of investing with less anxiety, reduce the emotional roller coaster of market volatility, and build your wealth steadily and consistently over the long term, then DCA is undoubtedly a strategy that deserves your serious consideration. It's not a get-rich-quick scheme, but rather a get-rich-steadily, get-rich-sensibly approach. It's about constructing a solid and sustainable financial future, brick by consistent brick, investment by methodical investment. Take some time to reflect on what we've discussed today. Perhaps do a bit more of your own research, explore different brokerage platforms, and see how DCA might fit into your personal financial goals and risk tolerance. The more you understand and the more comfortable you become with DCA, the more confidently you can apply it to your investment journey. And as always, we'd love to hear from you. Share your thoughts, your questions, your experiences with DCA in the comments below. Are you currently using DCA? Have you been considering it? What are your biggest takeaways from today's discussion? Thank you so much for joining me on the X100% channel. I'm Eddie, and it's been a pleasure diving deep into dollar-cost averaging with you today. Remember, investing is a journey, not a destination, and DCA is a fantastic compass to help you navigate that journey with confidence and peace of mind. Until next time, happy investing, everyone.